Have you heard about the new Trump tax bill and wondered how it might potentially impact you? Well, keep listening as we discuss some of the proposed changes and their potential impact to your wallet and your taxes. Hello, and welcome to the Wealth Minded MD podcast with your money best friends. I'm Dr. Leisha Taylor.
And I'm Dr. Brittany Halford.
And of course, we're here to help you build wealth and make good money decisions so you can create the life you desire with more control over your time.
Leisha, can we talk about one of the most important money moves we've made as doctors? And I don't know about you, but for me, when I think about this, it's actually insurance. Yes, I know it's not sexy, but it is absolutely essential, especially disability insurance.
Facts. I got mine right after med school, before residency even started. And let me tell you, Prati Botto at PKA Insurance Group made the whole process so smooth. He actually cared, broke down everything, explained the fine print, and got me the best policy for the best price.
And what I love is that he treats everyone like that, residents, attendings, even docs on visas. He literally got you. He's super responsive, super knowledgeable. And if there's a better deal out there, he will tell you.
Oh, and if you're healthy, you could get approved for up to 10 million in life insurance. So not just disability insurance in only 5 minutes. No labs, no hassle.
So if you're serious about protecting your income and your family, call 1-800-258-1018.
Or email pradeep at pkainsurance.com.
Well, Alicia, it's summertime and I'm so excited to have the warmth here. I know in Atlanta, it's been warm for months, but here in Boston, it's finally 80 degrees and sunshine. So, how are you doing? What's going on in your life?
Well, first, let me say, I had to ask myself, is God about to flood the earth again? Because it has just been raining cats and dogs in Atlanta. I said, maybe I need to start building an ark. It just every day it's been thunderstorming and raining. This is like the first day of like semi sunshine. And then tomorrow we go back to rain. I said, Lord, let me ask for forgiveness for all my sins before this world ends. Like, what is happening?
Oh my gosh, that is so funny. Whenever it rains, I'm just excited because I'm like, oh, this is such great sleeping weather. Let me see if I can catch a nap. This is me in my old age here, people. And then also, what they say, spring showers bring summer flowers. That's not the exact saying, but essentially that's what it means. And I have really been enjoying all of the flowers that I've seen on my walks. I'm like, okay, this is just the water that the flowers need in order to bloom and continue to grace me with their presence.
That is a really optimistic and positive outlook. Because when I see the rain, I'm like, man, again, maybe I need to adopt your mindset. Aside from the rain, I've also been preparing this like financial wellness session that I am giving to the graduating residents at our residency program. So, not just family medicine, but kind of all the programs. And I think it's going to be good. I've gotten so many text messages from the residents asking me various things about their contracts and what to do next. And so I'm like, all right, let me get everybody together and let's talk about filling out this W 4 you're about to get from your new job, making sure you have your tax withholdings correctly. And so, besides basking in the rain, I've also been preparing for this financial wellness session.
Well, Leisha, I am always so inspired by how often you give talks to the residents and try to keep them on the right track. I wish someone would have talked to me during my residency as much as you're talking to the residents because there's so much that we don't know. And even the curriculum that is delivered in medical schools or that medical students have access to, it's good, but sometimes it's not as tangible or it's not as applicable because you're not there yet, or they're not talking about the nuances, or you don't have the ability to ask questions right then and there as they're generated. So thank you for all of the education that you are doing. I also am preparing some talks, but my talks are not until August, so I got a little bit of time. And it's like, how do I deliver this message in a way that feels digestible? Because I know that sometimes finances can feel overwhelming, especially if you're still focusing on your career, trying to get medicine down. Hell, I haven't been thinking about like how I'm supposed to fill out this W-4 or whatever, So, how do I make it actionable during the talk? How do I make it feel less overwhelming and that this is something that they too can do and feel more empowered after leaving the session? I'm sure you do it well breaking down these difficult, complex concepts into more digestible, bite sized pieces. Any big takeaways that you're hoping for your audience?
That is a great question. I do have objectives in the talk. I haven't memorized them, but basically, I want to make sure that they're filling things out correctly, that they have the right insurance and kind of know what to look for, and that they have an idea for what they want to do with their attending paychecks. One of the things that surprised me was the amount that I paid in taxes. And so I don't want them to be surprised at that as well. And I always find that when you have a plan for money that you're going to get, you usually spend it a lot wiser or save a larger portion than if you didn't have a plan before you received that money. So I'm hoping at the bare minimum, they can do those things. And then obviously I'm a resource, so they can email me if they have any other questions.
Girl, you so generous. No, 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 no. It is definitely something that we should do. In fact, I'm meeting with one of our residents tomorrow to talk about some money stuff. And she's currently pregnant and she has one little kid. So, all about the balancing out mom life, work life, finances. It's a lot, but I'm grateful that we are a resource. And so thank you for listening to this podcast. If you have any questions, Leisha and I are here for you. So don't forget to look in the show notes and hit that button to ask us a question, and we can deliver an entire episode to share with you in detail and answer all of your questions. All right, Leisha. Well, I got another question is what money mishaps have you been committing lately, girl?
It's so funny that you ask. I basically am just now taking full advantage of some of my work benefits. Let's just say I didn't start it from day one. I had been working at my institution for a full year before I realized that there was a cell phone benefit. If you use your cell phone to like communicate with your colleagues and whatnot, or you have the Teams app on your phone, they give you like $20 a pay period as a cell phone benefit. And I was like, man, it was like a year in till I realized that. It wasn't until a few weeks ago that I finally got a parking pass at my job. I had actually been paying for parking. It's like $50 a month for this lot across the street when there is technically a lot connected to my building. And I don't know what happened. I think when I was hired, I was previously told that there weren't any more parking passes for that lot or whatever. And I just was like, okay, I guess that's fine. I'll walk across the street. But a few weeks ago, I talked to our operations person and I was like, can I get a parking pass? She said yes. So now I have free parking and I have my cell phone benefit. So, it took a while, but better late than never.
Better late than ever, for sure. And as you're talking about the cell phone benefit, one is that separate from your CME, your continuing medical education money? Okay. And I need to look to see if they've reviewed or revised our benefits because now that we've converted to Epic, we are required to do this whole Epic chat thing. And there's no other way to do it unless you have it on your phone, especially as you're rounding, seeing patients and things of that nature. So using our cell phone is required. I'm sorry, I'm like getting on a soapbox here about your money missing. But I hate that our employers are requiring us to download these additional apps, but they're not providing our cell phones. I don't know if you have to have an app for the work that you do.
Yes, like the Google Authenticator thing whenever I log into my
Okay.
email or a system, even like some of these other apps to like, use Dragon, which is that program where you can speak your notes about, you
Mhm.
know what I mean? Like there are
Mhm.
definitely several apps that I have to have for work on my cell phone.
Yeah, yeah. I'm happy that your company is at least subsidizing a little bit because most companies don't. But yes, it's a requirement in order to be efficient at your job. So maybe I should go back to my employer and negotiate this benefit, girl. And the free parking thing, that's so funny because recently my husband did the commencement speech at his medical school, Southern Illinois University. So it's in Springfield, Illinois. And he was leaving the parking structure and it was $4 or $7 or something like that. And he's like, what? Should I go back in and like come back out? Because parking is so expensive here in Boston. I don't know how much it is to park per day in Atlanta. Probably like what, $20?
That sounds about right if you're trying to park downtown, although it can vary. Some places allow you to park by the hour or pay by the hour.
Okay. Yeah, it's more like $40 here. So it's super expensive. So I'm glad that you'll get 20 extra dollars per day, which is substantial back in your pocket.
Well, not per day, per pay period now. So it's not a huge benefit. Don't get
Oh,
too
okay.
excited, but It is $40 a month that I wasn't previously getting. So for me,
Okay,
I'm like,
okay.
okay, free money.
Yeah,
I'm
yeah.
gonna get another what, $400 or $500 a year. I will take it. I'm not gonna turn down free money, but it is
Right.
not as much as you thought.
Okay, okay. Well, it's just like all these additional taxes for the work that we do. And I don't know about you, but I work at least a third of the year for free, unfortunately, due to taxes.
As physicians, one of the most important things that we can do is make sure that we secure our income because a lot of our financial plans are contingent on our high doctor income. One of the things that you will need to do is make sure that you get long term disability insurance.
Now, Pradeep and his team at PKA Insurance Group have a reputation for putting people over profits and always doing what's best. Do not hesitate to email PKA Insurance and his team today.
They will help you get the insurance you need with the service you deserve.
Are you ready to negotiate like a boss? Let's be real. Most employees don't negotiate, but their employers expect them to. That means you're literally leaving money, benefits, and flexibility on the table.
But not anymore. Just as our client, after going through the Negotiate Like a Boss Accelerator, she landed a big salary increase, the schedule she actually wanted, and more time to spend with her family and pursue her passion.
You'll get proven scripts and tools to negotiate with clarity and confidence, live hot seat coaching to practice and perfect your pitch, and real time feedback so you're not guessing, you're growing.
Because, like I always say, I work better when I'm paid well. Don't wait. Procrastination is a pricey mistake.
Enroll in Negotiate Like a Boss Accelerator today. Click the link in the show notes. This opportunity will not be around forever. As we talked about in the teaser for this episode, that there have been some proposed changes to tax bills, and they will likely affect us as physicians and high income earners. So, Leisha, let's talk about some of these changes and what we should be maybe grateful for as high income earners and how they will affect the work that we do, the money that we bring home, and also how we're continuing to build wealth.
Yeah, yeah. So, first, let me state that this bill has not been passed. This is what has been proposed. And I think that although it passed the House, if I'm not mistaken, at least at the time of this recording, it hasn't passed the Senate. And I presume that some changes will take place before it potentially passes in the Senate. If I had a crystal ball, I would say that I think it's likely that some sort of version of this bill gets passed. And so, although it isn't in its final form just yet, I think it's important for us to be aware of at least what is being proposed so that we can have a heads up of what may be coming down the pipeline. First of all, let me say, I did not read all 1,000 plus pages of this bill. So I want to say that very clearly now, but I did pinpoint some highlights in the bill that, as you stated, Brittany, I think are more likely to affect us as high income earners and maybe those that we know personally. So this isn't everything that's in the bill, but I'll try to kind of hit on some of the big points. All right, so number one is this tax bill. One of the main things in it is basically a permanent extension of some of the tax cuts that were originally started in 2017. So if you remember, President Trump was initially elected, right, in 2016, and then there was the Trump Jobs and I think it was the Tax Cuts and Jobs Act that was passed in 2017. And in that initial piece of legislation, there were certain tax cuts that are set to phase out over time. And so one of the things in this current proposed bill is to basically extend those tax cuts permanently. So let me give you some examples of some of the tax cuts that were initially started in 2017 that if this bill passed will continue indefinitely. So one of those is the standard deduction. Before the Tax Cuts and Jobs Act in 2017, the standard deduction for a single person was I think it was around $8,000 a person. And for a married couple, it was around $15,000 per couple. Well, in 2017, that was essentially doubled. And so nowadays, the standard deduction for a single person is what, $13,000, $14,000, something along those lines. And then if you are married, you double that. Well, one of the things in this current tax bill is it will extend those current rates. And so basically, the standard deduction provision that was set to expire will be extended. as it stands now, if this version of the bill gets passed, then the standard deduction for a single person will be actually around $16,000 when you file your taxes next year and around $32,000 for couples. So this is a long-winded way of saying the standard deduction, if this bill passed, will increase a little bit and be increased indefinitely.
Okay. Well, I think that's interesting that the indefinitely part and these permanent changes, I try to keep my head out of politics and how all things work. But speaking to the standard deduction, I think one of the things that I'm considering is for those who itemize versus those who don't. So when we first started, before we purchased a home, we really did itemize. We didn't have businesses. So there wasn't much that we were taking as far as an itemization. I always tried, but I never quite equaled the standard deduction. So we would always take the standard deduction in order to reduce our taxable income by the most because the standard deduction was greater than our total for the itemization. For us, this doesn't matter as much, I think, because we itemize our taxes. We have business deductions. We own two homes and properties and things of that nature. So this isn't a huge boost for me. I'm not super excited, but I could understand how a couple who is not itemizing their taxes and taking a standard deduction, they're excited that they get to keep more of their money because now the standard deduction is a bit higher.
Yeah, that's exactly right. And that's actually what a lot of people were kind of talking about is for high income earners such as us who maybe also have businesses and real estate and things of that nature. A lot of us already itemize our taxes, so it doesn't affect us as much. But for the average American, they actually do use this standard deduction. I think there was a statistic that when the standard deduction was doubled in 2017, way more people, way more couples started using the standard deduction. And so what they didn't want was to pass a tax bill and have the average American have an increase in the amount of taxes that they owed. And so they really wanted to extend that standard deduction because it affected so many Americans. And so I agree with you. It doesn't really affect me personally because I itemize my taxes as well. But for those who don't, maybe if you are a resident physician, maybe if you are an attending physician that maybe doesn't make as much as others or has a non-income earning spouse or has multiple children or whatever, in which case the standard deduction would benefit you. This is something that you want to pay attention to because it will hopefully help to keep your tax bill lower than it could be otherwise. And so I agree with you. Standard deduction may not affect us, but it may affect some other doctors and people that we know.
Just one other thing that came to mind. We had that episode about hiring your children. And
Oh,
so
yeah.
this could be helpful, right? As my child is now able to earn more without paying taxes. So this will give me a greater business deduction. I can have her work more hours and therefore pay her more and pay, hopefully, KJ will find a job soon. He's only 4 people. And then that way we could put more money into their Roth IRA. So if you haven't heard that episode, definitely go back and search Hire Your Child, and we can have our editor, producer put that in the show notes for you as well of like how to hire your child and how to save and invest their earned income. I can see that as one benefit of having this increase in standard deduction for me personally.
Gotcha. Okay. All right.
Yeah.
So maybe it doesn't affect you directly, but indirectly, it might be a benefit because you do some funky maneuvers, which are really great for you, which is hiring your kids and having an increased standard deduction would benefit that. Another thing that would be extended is actually the individual tax rates. So in 2017, when the Tax Cuts and Jobs Act, oh my gosh, that's a mouthful. When the Tax Cuts and Jobs Act was passed in 2017, it changed the tax brackets. Before that bill in 2017 was changed, the highest tax bracket was actually 39.6%. When the Tax Cuts and Jobs Act was passed in 2017, they lowered that so that the highest tax bracket was around 36 or 37%. In this current version of the tax bill that is proposed, it would extend that. So basically, instead of having the tax brackets go back to what they were in 2016, where the highest tax bracket was 39.6%, it would remain at 37%. Now, of course, that doesn't prevent them from changing it again in the future, but they're just saying, hey, we're not going to revert back to the tax brackets that we had 8 or 9 years ago. We're going to continue on with what we have in place right now.
All right. So I guess this can be helpful because I'm continuing to earn, I'm making more money. And so if there's a cap on how much federal income tax I have to pay and that cap is lower, then that means that there's more money in my pocket that way. So I can see how this could be beneficial for some of the high income earners. The one thing that I always think about with taxes Of course, I don't like to pay taxes. Everybody knows that if you listen to this podcast. I also want to ensure that I'm using money and that the understanding that the taxes have a role, right? They typically support Medicare, Medicaid, reconstruction of public settings. And so they have a purpose. I definitely understand that. So I want to make sure that because God has blessed me, I can also continue to bless others. So as we're being capped out on some of the federal income taxes that we have to pay and keeping more money in our pockets, just ensuring that we just are not going out and spending the money when we still need to continue to do good in the world because people need us.
Gotcha. Look at you trying to put a positive spin on that. I mean, I know you pay a hefty sum to your tax advisor, so I already know what the deal is, but I appreciate you trying to be optimistic. I'm happy about this. This doesn't necessarily affect me because I am not in the highest tax bracket, but Lord willing, I'm going to continue to progress and be promoted and make more money. And eventually I'll be in that high tax bracket and would certainly love to save some money on taxes when I get there. So I'm not too mad about this one. Okay, Brittany, another thing that is going to be extended with this new proposed bill really does affect doctors, and that's in regards to estate planning and the gift tax exemption. So before 2017, when Congress passed the Tax Cuts and Jobs Act, there was an estate planning limit. So if you happen to pass away and you had, I think, more than like 5 or 6 million in your estate as a single person or double that as a married couple, you had to pay estate taxes. And I believe that the estate federal tax rate is like 40%, right? So if you were some multimillionaire physician couple, or let's say a famous actor, celebrity, or whatever, and you died with, say, $20 million, the federal government would tax you 40% of the amount over the estate tax limit. And so a lot of physicians, if you're working for 30 straight years and you're maxing out your work retirement accounts and putting some extra into other investment accounts, it might not be unreasonable that a dual physician couple who worked for 30 years might amass a net worth of maybe 10 million or more. And in that case, doctors had to do some really good estate planning to prevent their heirs from getting, 40% tax cut on what they were left when the parents passed away. Hopefully that makes sense. But anyway, in this new Trump tax bill, they are extending the current estate tax limit. And so now, instead of your family or your estate having to pay 40% taxes if you have over 5 million as a single person or 10 million as a married couple, it continues with what the rates are right now, which is actually going to be around 15 million for a single person in 2026 and double that for a married couple. And so I think with these new estate planning exemptions or extensions, right, a lot of physicians, a lot of high income earners may not have an estate tax problem. Meaning, if you're married, if your estate is under 30 million, if you're not married, if your estate's under 15 million, your heirs will not have to pay any estate taxes.
When you talk about this, Alicia, one of the things that I'm thinking about is, man, those are some big numbers. I wonder how many physicians actually have amassed that amount that they are going to leave as a legacy. I don't know the numbers for that, but I would imagine that there are few physicians who kind of fall into that bucket. We ain't there yet, people, but that's goals. That is goals for us. And so for me, it's what brings to mind is okay, understanding that as you are thinking about your legacy, that there's also going to be a tax on that, right? And so how do you plan accordingly? So regardless if this is going to be the bill moving forward at your time of death, who's to say? No one knows their death date, but how can you plan accordingly so that you can protect more of your wealth and leave that legacy behind to those who matter most? So I think that that's what is coming up for me, not necessarily the numbers because I ain't got the numbers yet, but whatever I do have to leave behind, let me be very thoughtful and strategic about how I do my estate planning so that we can retain wealth and perpetuate wealth.
Yeah, yeah. This really comes to a head because I think a lot of doctors are sold whole life insurance by a lot of financial advisors or insurance companies. And one of the things that those sellers will mention is, oh, it'll help prevent your estate from having to pay taxes. They talk about all the tax benefits. I could understand that for people who are like multimillionaires, athletes, celebrities that have 10, 30, 50, $100 million worth in their estate. Like, yeah, that makes sense because you're going to have an estate tax problem, right? If you pass away, your estate's going to have to pay 40% of what's over that cap. But now that they're extending the limits, I think a lot of people are going to fall under that limit and therefore not have an estate tax problem. And so I think this is great for a lot of people. And this also extends to the gift tax exemption. So, Brittany, I think you're aware of this. Like, you can gift, I think it's like $17,000 or $18,000 a year to anybody without having to file any tax. Nobody has to pay any taxes on the gift amount or whatever. But if you give more than that, it's not that you have to pay taxes. You just have to file a form because it subtracts from your estate tax limit, right? And so if you gave somebody $1 million in 1 year, it's not that you have to pay taxes on that million or they have to pay taxes on that million. You just have to file a gift tax exemption form when you file your taxes, and they subtract that million from your estate allowance when you die. So right now, or at least in 2026, when people file their taxes, the estate tax limit for a single filer is 15 million. So if you gave somebody 1 million, well, that's over that gift tax allowance. And so that would subtract from that. So when you pass away, now your heirs would only get 14 million tax free or whatever. Hopefully I didn't confuse people. I was just trying to say that I think that for a lot of high income earners, no matter what your profession is, just knowing what the estate tax limit exemptions are and when you have to pay taxes is really helpful from an asset management standpoint and estate planning standpoint. So I just wanted to mention that there.
Yeah, there's nothing wrong with acquiring this knowledge and understanding what's in the bill, right? That's why we're doing this episode. And just also knowing that laws and legislation impacts our finances and how do we plan accordingly, whether there's someone who's more conservative or someone who's more liberal in office, so that we can, again, make sure that we are protecting our assets to the best of our ability.
The other thing I want to mention real quick is actually there's this new charitable deduction for people who do not itemize their taxes. Now, with this new Trump tax bill, of course, if it gets passed, people who take the standard deduction, they can deduct single filers up to $1,000 a year, married couples up to $2,000 a year from their taxes, even if they do not itemize. So the way it works now, if you give a ton to charity or church or whatever, you can only get a tax deduction if you itemize your taxes. But if you do not itemize your taxes and you instead take the standard deduction, you don't really get any reduction in taxes for giving money away to charity. Well, with this proposed Trump tax bill, that will no longer be the case, and people can deduct $1,000 if they're single, 2,000 if they're married, no matter how you file your taxes. And so if you take the standard deduction, then it'll give you a little tax break there if you give money away.
All right. I love that. Come on, let's be philanthropic, people. That's not going to equate to a ton of money in savings on your taxes, but it's something. And so every little bit counts. And I think if there's a way to incentivize philanthropy, then why not? Hopefully, this is not the only incentive, that people are also thinking about all the other benefits, all the other contributions that we're making in the world through our charitable giving. But yeah, I say that's helpful. That's something, a win for the people.
One of the things that I wanted to mention that's in this tax bill that definitely does not affect you and I as physicians, but it might affect physicians who have teenage children or physicians who have cousins or family members or maybe close friends or children of those close friends who are maybe working in service industry jobs. So one of the things that President Trump had campaigned on was the whole no tax on tips thing. So I figured I might mention how that's being proposed or affected in this bill. And so that's actually in the bill, no tax on tips. But there are a few nuances that I think people should be aware of. Number one, it actually only affects tips in which the customer decides how much they want to tip. So oftentimes, I don't know about you, Brittany, but I'll go to restaurants and there'll be an automatic 20% or an automatic gratuity. It actually does not affect that. And so all of these places that have started this like standard gratuity amount, those amounts would actually still continue to be taxed. It only affects the tips where you decide how much you want to give. It also has limitations. So the House of Representatives said, we're going to limit the deduction to people who make under $160,000 a year. So if you make more than that, then this no tax on tips does not apply to you. And also the max amount that you can deduct is $25,000 of tips. Now, granted, if you're making $25,000 of tips, that's pretty good. But if you're making more than that, that'll definitely be taxed. One of the things that people talked about was, well, dang, maybe I should add a tip line on my job. You know, I provide a service to the community. Not so fast. So according to this bill, the credit will only apply to jobs that the government specifies typically receives tips. And so in order for you to have this whole no tax on tips thing, you actually have to work at a job in an industry that's on the list. So you can't just like doctor's offices can't just start adding tip lines and then be like, that's tax-free income. So there are a few nuances there. There's no federal tax on tips, which you still have to pay FICA taxes, so you still have to pay Medicare and Social Security taxes on it. But I just figured I would mention that in case somebody you know, Brittany or whatever, has a teenager that's in the server industry and had talked about this whole no tax on tips thing.
I have not talked about this with anyone, but I'm always curious of how the government monitors these things because a lot of times tips are given in cash. I could understand if they're given per credit. I'm just curious with all the definitions, the rules and the regulations is how is this actually being monitored? But I also appreciate that there's a limit and there's some restrictions so that people cannot game the system. And it allows for people who are performing a service who typically it's minimum wage or under the amount that they're making. So it allows for them to really take ownership over the work, provide a good service, and then be able to capture all of that in gains for the work that they're doing. We'll see how this shifts the service industry. I would be curious to see how this also impacts restaurants.
Yep, I agree with you. I agree with you. All right, Brittany, along with the whole no tax on tips things, there's another thing that probably won't affect you and I, but may affect some resident physicians or other people. And that is this new proposed change to be able to deduct your auto loan interest. So, right now, you can deduct your mortgage loan interest. And so, if you have a mortgage on a home, you can deduct a portion of that or maybe all of that interest on your taxes. And so, that really helps homeowners. And so this new thing in the Trump tax bill will actually affect auto owners. And so people who are buying new cars. And so it's basically you can deduct $10,000 in auto loan interest. So if you buy a car and you take out a loan, you can deduct up to $10,000 of the interest on the loan from your taxes. But the only thing is that this only applies to cars that are made in the United States. And it begins to phase out for people who make over $100,000 for single filers and double that for married filers. And so instead of just helping out the homeowners, they're going to help out the car owners too. So if you buy a car, then you might be able to deduct some of the auto loan interest depending on your income.
All right. So this doesn't help me. You all know my car is 20 years old and it's getting to the point where I need to purchase a new car. So we're not there yet. And I don't know how much this is actually going to impact many of our listeners. Of course, if you're a resident physician still in medical school, then yes. But for the high income earners, they're likely going to phase out from this benefit. However, there might be other creative ways for you to purchase cars. Have your adult child to purchase a car and get a little bit of a loan if you want, if there's a 0% interest loan or something like that. So I can see how they're trying to make some of these things more affordable and also bolstering the US economy, that industry. But I don't know how much this is going to help out high income earners.
Yeah, I agree with you. There's another thing in the bill that I kind of feel similarly about, and it is the no tax on overtime. So we talked about the no tax on tips, but now with this new Trump tax bill, if you work overtime and you earn under $12,500 a year from your overtime pay, then you can deduct that on your taxes or not have to pay any federal taxes on that amount of overtime. Now that begins to phase out if you make less than $150,000 for singles and double that for married couples. And so I don't know about you, Brittany, but I worked a lot of overtime as a resident, but it was not line itemed as overtime. Maybe for some doctors who are not in training, maybe it is line itemed as overtime. I don't know. But the no tax on overtime might help some people too.
Yeah, it'll be interesting to talk to administration, human resources at our employers because I wonder if moonlighting could be characterized as overtime. And if that is the case, then that would allow for a lot of us to shield some of our income from taxes. It's the devil in the details, and it's all these nuances that you just have to see if there's a way that you can leverage it. So perhaps there is a way that we can talk to human resources or whomever to say, hey, could this be characterized differently so that therefore it be taxed differently? So very interesting. I should probably bring this up with my boss to see what they say. You never know unless you ask. So there's possibility. I'm hopeful. I'm hopeful.
We'll see. I don't know. I feel like they're going to find a way not to do that. So we talked about the no tax on tips. We talked about no tax on overtime. Obviously, these have different thresholds and qualification requirements and income things and whatnot. Another thing that might actually help doctors is this QBI deduction. So it's the qualified business income deduction. Brittany, I'm sure you've heard of this. For those of us who have sole proprietorship. So let's say maybe you are a physician who only works locums, you do contract work, or maybe you're a physician who is employed, but then you do other work on the side, whether it's you selling stuff on Etsy, selling stuff on Facebook, working extra shifts at the urgent care, maybe you have a small business, whatever it is. But let's say you have your own small business, so to speak, on the side. When you file your taxes, usually there's a QBI deduction, qualified business income deduction, that allows you to basically deduct, I think right now it's like 20% of your business income from having to pay taxes on that. And so that's a big deduction for a lot of people. I file my own taxes, so I see the numbers and I see how it helps me. And I'm like, oh, yes. Yes. And so in this new Trump tax bill, I think they're going to extend that. I think it's like 20% deduction up to maybe like $50 to $75,000 for singles and maybe double for married couples. There's some nuances in there, but the point is that I think they're going to extend the qualified business income deduction. And so that might help all doctors, especially those who have some 1099 income.
Yeah, like you, I'm always grateful for any deductions, especially that deduction. So you all should let us know how many of the physicians who do locums work actually feel that this is beneficial, because a lot of us also are W-2, but this speaks to how can you recharacterize your income? How can you ask for different types of income or create an additional stream of income so that you can get this benefit passed through to your taxes? I am excited about this one, like bonus depreciation one that we will talk about, or we did talk about. I think this could help some people, but again, we just got to remember that we're not the only citizens in the world. And so we just want to understand how these implications have more global impact.
Yeah, I should also mention, I believe that there are some stipulations on the QBI deduction that if you do certain professional services, and one of which might be medical services, it might be exempt from the QBI deduction.
Oh,
And I think that's the way it is now too, if I'm not mistaken. Like I said, I do my own taxes, and I want to say, like, when you have a 1099 income, especially if you have an EIN number, an employer identification number, when you are applying for that, they make you put in like what kind of services you provide. And I think that when you're qualifying for this QBI deduction, certain professional services are exempt from getting this deduction. I could be wrong about that. So if somebody is listening to this episode and you know the ins and outs of the QBI deduction, please let me know. But I want to say certain services may be exempt. And so if that is the case, I don't know if you can just be a physician 1099 income and deduct like 20% of your physician income from taxes. I want to say that they've exempted that, but it would work if you were a physician like you and you have another sort of unrelated business on the side that isn't like you providing direct medical care. So I still think that it helps a lot of physicians, but some of the nuances I'm a little fuzzy on, admittedly. So just wanted to throw that out there before people get too excited.
yeah, I was trying to look it up quickly, but can't find it in the exact details that I want. So, all right, people, we'll have to get back to you on that one. Or if you have a tax accountant, then feel free to have a conversation. I think one of the things that I've really benefited from is just learning what could be available to me and then researching it and understanding how to apply it to my situation, or asking and bringing it to my tax accountant to understand if this could be applied to my situation. So, all right, Leisha. Well, thank you for at least planting that seed of curiosity for all of us.
No problem, no problem. The next big thing that I thought was very intriguing was changes to the child tax credit and this new proposed change for newborns. So let me explain both. So before the initial Tax Cuts and Jobs Act, the child tax credit was limited to around $1,000. But with the Tax Cuts and Jobs Act that passed in 2017, I think it was with the Tax Cuts and Jobs Act, or it might have been with one of the legislation that the Biden administration put into place. I can't remember which administration put it into place, but be that as it may, the child tax credit was actually increased to around $2,000 a year. In this current proposed bill, they would raise the child tax credit to around $2,500 per child. Now, this phases out if you make at least $200,000 as a single person or $400,000 as a married couple, but there's this basically extension of the child tax credit. So that's part one. The part two, which is actually very new and is for newborns, is what they are calling Trump accounts. Brittany, I'm not sure if you've heard of this, but it's basically a one-time $1,000 seed deposit into an investment account for any newborn that was born within the years of 2025, so January 1st, 2025, through the end of 2028. So everybody born between 2025 and 2028 will get $1,000 in an investment account. And that money will be invested into a low-cost, broad-based index fund. And parents and family members or whatever can add up to an additional $5,000 in the account per year. And that money is to stay in the account until the child turns ages 18 through 30. So basically, the child is able to access the money, at least half of it starting at age 18. they have full access to all of the money at age 25, and they have to completely use all the money by age 30. And what it says in the bill is basically this money is supposed to be used for educational costs, if they want to use it to buy a home, starting a business, etc. But it has been deemed these Trump accounts that's supposed to sort of set someone up for financial success in the future.
I've heard about this. I think that the idea is a solid idea. I appreciate that we are thinking about how do we set our kids up from the beginning. Because if you imagine that you put this $1,000 in and you have it invested in some low cost index fund, then over time, now I'm not doing the calculations, but over time it's going to grow to substantially more just because of time and compounding and leaving that there. And so I can understand how for many families, this will be a great benefit to that family to offset costs, to offset college expenses, to give children a leg up. One hesitancy, I think, with this is some of the other changes with education, funding, student loans, things of that nature that I think is going to be insufficient. But hopefully, it's planting a seed. It's planting a seed that if somebody's monitoring it and they see the growth, oh, what if I add more? What if I put $20 more? How much more can my child have? And just by starting them out investing, then it will allow them to see the benefit of investing and putting their money into these accounts and having passive income. So I think that there are many, many, many great benefits from doing these Trump accounts. This has been proposed by some other politicians and legislators as well. And so I think that it has some great benefits.
I think it is well intentioned, or at least it seems to be. I'm not sure if $1,000 as a one time thing into an account is going to do as much, but I share your sentiments in that it's better than nothing. We will see what ends up happening with this. So, yeah, those are the Trump accounts and the preservation of the child tax credit. Next thing that I think is important to mention is the SALT cap increase. What is the SALT cap increase? So SALT stands for state and local tax deduction. And so basically the way the law is written now is that you can deduct up to $10,000 that you pay in state or local taxes or property taxes from your federal taxes, right? So you take the amount that you pay in state taxes or property taxes, you can deduct up to $10,000 of that from your federal income taxes so that you are able to reduce your taxes that way. So right now the cap is around $10,000. In this bill, it would actually raise the cap. So it would raise the amount that you are able to deduct from your taxes to $40,000. And this will apply to every household as long as they make under $500,000 per year. And so if you are a physician and you're in the high tax bracket, let's say you're in the 30% tax bracket, then being able to deduct $40,000 from your taxable income will save you, $10,000, $12,000 in taxes per year, has the potential to save you that much money in taxes per year, potentially. So Brittany, I'm curious to hear your thoughts on this.
I think that this could be helpful for us to retain some of our income, especially for high income earners. I wonder how many dual physician households are earning under this 500K. I don't know those percentages, but I could see the benefit of reducing our federal income tax and retaining some more of our money. I wonder how this impacts state and local governments. I would think that it will have minimal impact given that it's just a deduction that's passed through to your federal income tax. So in this case, I think that it could be extremely helpful. Anything that allows us to retain more of our money and to be very intentional about how we're spending it in the lens of us also doing more good with what we're retaining. So I don't have any negative thoughts about this. I think that this could be positive, but my only concern is if it has any impact on state and local governments and what they're able to do. And I'm not sure exactly how it impacts them. I would think minimally, but I'm not for certain.
I would think minimally as well. I was thinking about this and I'm not sure how much this affects me. Maybe a little bit, but not much because I don't own a home. And so I don't actually pay that much in property taxes each year. I live in the state of Georgia and our state tax rate is actually not that high. I think it's around 5%. So increasing the amount that you can deduct from 10,000 to 40,000, I think really affects those people who pay a lot in property taxes. So anybody who owns a home, or you live in a state like California where the amount that you pay in state taxes is very high. And so this is one of those deductions that I think really does help high income earners the most. High income earners who happen to also be homeowners. probably the most, but I'm not mad at it. Eventually, I'm gonna be a homeowner and it's gonna help me. I am not mad at this. One of the other things I wanted to mention, a couple of little tidbits I wanted to throw in there that are a little unrelated, but I think are important to mention here, is one of the things that's in the bill is actually rolling back some of the green energy incentives. So the Inflation Reduction Act, which I believe was passed under President Biden, one of the things that was included in that was credits, so tax credits when you invest in certain forms of energy and even in electric vehicles. So at the time that we're recording this, there has been this rift, so to speak, between Elon Musk and President Trump, right? And some people feel like part of the reason for that rift, maybe not the full reason, but part of the reason is because in this proposed tax bill, President Trump is eliminating some of the credits that people get for buying electric vehicles. And Elon Musk, in his role in Tesla, that would obviously affect his company. And so I'm not sure if all of that is true, but it is true that in this bill, they would roll back some of the credits that you get for purchasing electric vehicles, for investing in like solar energy in your home, and some of those things.
Think this one could be a bit damaging in some regards. For me, I enjoy walking in order to decrease on my transportation costs, but also to decrease environmental impact. Recently, I had a conversation with a woman who has solar panels on her home, and she wasn't aware of all of the details. She told me to talk to her husband, but about us maybe getting solar panels on our home. And it is an incentive if you can get the tax credits. More people would do it because it's an out of pocket expense, right? And so if someone can see, okay, this is going to not only help the environment, but also help me even just a little bit financially, then we can promote that positive behavior. With this rollback, I think people might be less likely to do it, but those who are still environmentally inclined, those who really want to support ensuring that our kids have as good, at least, of an environment to grow up in as we do right now, then they're still likely going to do this without the green energy incentives. However, I'm just a bit concerned because we know that global warming is real. The ozone layer is not as thick as it used to be. And so trying to promote positive activities, this makes me feel like maybe there will be fewer people who might be investing in these initiatives. Hopefully, with some of the other tax breaks and incentives, people will still be able to create margin within their budget and see that investing in green energy is still an action worth taking.
I hear you. I run into people who have invested in those kind of solar panels and purchase electric vehicles. And part of the incentive for doing so was the tax cut. But as you mentioned, if this is something that you're really interested in, I think people will still find a way to do it potentially, but we'll see. We will see. You know, another thing that's in this bill that you might actually love, Brittany, is extending accelerated depreciation. And so this affects a lot of people who have real estate properties. So in 2017, when the Tax Cuts and Jobs Act was passed, one of the things that real estate investors got really excited about was this ability to do bonus depreciation. So essentially, if you have a real estate property, let's say you have a home that you're renting out, one of the things that you could do was a cost segregation analysis, right? So separate how quickly do the windows need to be depreciated? How quickly does the land need to be depreciated, et cetera, et cetera, et cetera. So the different elements of the home. And then you could do bonus depreciation. So depreciate all of that stuff in 1 year. Essentially what this amounted to was you were able to take a big deduction on your taxes the first year in which you bought the property. And so real estate investors loved this, right? Because they could essentially purchase a real estate property and deduct almost the full cost of that property on their taxes the first year. So basically, they would save themselves lots and lots of money in taxes the year that they purchased property. Well, in 2023, that bonus depreciation started to phase out. And so one of the things that is in this proposed bill is extending that bonus depreciation. And so essentially, you will be able to do full 100% bonus depreciation on any purchases of real estate, you know, that meet certain parameters between the years of 2025, so right now, and 2030. And so this really does serve as a benefit, it seems at least, to real estate investors.
Yeah, I have heard about this and recently had a conversation with my husband and also my father about another opportunity that we are considering, which is purchasing a small business that is equipment heavy and how I could leverage that in our tax strategy. So, yes, this is one that I am a bit more excited about because I've been planning strategically around the acquisition of this business and then purchasing of the equipment and how I would leverage that to reduce our taxable income while also creating cash flow. You know, taxes aren't everything. I'm a bit more excited about this one as it not only extends to real estate, but also purchasing equipment and things for small businesses, even like vehicles and some other machinery and things of that nature. So I think this is one that could definitely be leveraged, especially if you're considering your strategy for the next 5 years and how to really leverage what you have in order to make the most of it. So I'm excited. I'm curious. I'm watching.
Oh, goodness. I knew you'd be excited about that one. So maybe some of the not so shining parts of the bill that I think may not affect us personally, Brittany, but may affect some of our patients and the way that we deliver healthcare. So one of the things to mention is that in this proposed bill, they do have significant cuts to safety net programs and health insurance. So Medicaid, I mean, there are pretty extensive cuts. So some of the things that they put in there are work requirements for adults between ages 18 and 64 who don't have dependents. There are different eligibility limits. And so now people who maybe used to be eligible for Medicaid in the past will maybe no longer be eligible. There are redeterminations of eligibility requirements. So the way it works now is every year you have to qualify for Medicaid. And in this proposed bill, they would make you requalify every 6 months. There are increased copays for people on Medicaid. And it's a sliding scale based on how much you make. There are exclusions for undocumented workers. They're also rolling back some of the subsidies that were initially in the Affordable Care Act, also called Obamacare. So there's delayed enrollment opportunities. There's a shortened open enrollment period. Some of the subsidies are going to be going away. Also, in there, they mentioned no government funding for providers, so physicians, non physician providers who provide abortion care. They gave Planned Parenthood as an example. No funding for providers who provide gender affirming care. There are reductions in SNAP, so that used to be called food stamps, stricter work requirements. The states have to contribute more, the federal government will contribute less. And so I know that's kind of a hodgepodge of things, but I wanted to mention that everything in this bill is not great. It's not just a bunch of tax cuts for the wealthy or the well off. There also seem to be, at least per my scouring of this bill, some significant cuts to safety net programs like Medicaid, SNAP, aka food stamps, and some decreasing of the subsidies for health insurance.
Yeah. So this is just in the hesitancy of the Trump accounts, right? And so the $1,000 is good, but it's not enough, right? We want to make sure that we are still are able to support our most vulnerable populations. And Isha, I'm sure you share the sentiment. Like one of the reasons that I got into medicine is so that I can do that, so that I can help patients to heal not only physically by understanding the physiology and what's going on with them, but also ensuring that I'm an advocate for them to ensure that they have some resemblance of a home environment, of nutrition, of whatever, social determinants of health that need to be addressed, that I can also work on those and advocate for those. Because healthcare is one thing if when they're in the clinic, but then you have to send that patient home, And so if they can't afford their utility bills to refrigerate their insulin, then how do we expect for them to manage their diabetes? So one of my greatest concerns is that through some of these cuts, we're not only putting patients in a vulnerable condition, but we're also disincentivizing physicians from working with patients who receive Medicaid, because who's to say if their Medicaid is going to be renewed and that provider is going to be paid? So I think that this has a lot of downstream impacts, not only for the state of our healthcare today, but definitely down the road and the health of our population in general. Because if you're stressed out about other things, then you can't think creatively. If you have to have amputations because your diabetes is not controlled, then you're not going to be able to really contribute meaningfully to the workforce. So I think that this has many negative downstreams effects. And I think I'm really concerned about this change.
I agree with you, especially concerned for me about the federal funding for providers who maybe provide a different type of care than the government seems willing to support at this time, and what that means for the patients in which they serve. And so I definitely think that that is an area, especially of concern. And it's one of those things that obviously doesn't affect us as recipients of Medicaid because we don't get Medicaid, right? And we're in a blessed position to be high income earners, but it does affect our patients, as you mentioned, and the people that we went into medicine to serve. And so definitely something to keep an eye out for, especially also trying to think about the downstream effects that could have been unintentional that might also affect us as physicians and our patients. So maybe a not so good thing, it seems, in this bill. Another thing that I think is important to mention, and there are a million things in this bill, but this is probably going to be the last thing I think that we mention in this episode, and that is the proposed changes to student loans. Brittany, you and I are probably going to do a whole episode on student loans, so we're not going to hit everything today, but I just wanted to hit the highlights of at least what's in this proposed bill. And I want to make it clear that what's in this proposed bill bill is separate from public service loan forgiveness. So when we do our student loan update, we'll try to lump those things together and make it clear. But in this proposed, at least, tax bill that may be passed, there are a few proposed changes. So one of the things that is in this bill is to basically revamp the student loan repayment plans. So currently there's lots of different plans, right? There's a set of income driven repayment plans, right? We have income based repayment, income contingent repayment. We had the save plan that's now on pause. We had pay as you earn, like all of those different things. And then we had non income based repayment plans like the standard plan and the graduated plan and et cetera, et cetera, et cetera. So in this bill, they would eliminate most of the plans and only have two. And essentially, you would have the standard repayment plan, which puts you on track to pay off your loans in 25 years. And you would have what they're calling the RAP plan, I believe. It's the repayment assistance plan, which is an income based plan that makes you pay between 1 and 10% of your income based on how much you make. So if you make at least $100,000 a year, you'll be paying 10% of your income to each month to pay down your student loans. And then you get forgiveness after you've made 30 years of qualifying payments. So the way it works now is if you're in an income-driven repayment plan, even if you're not enrolled in public service loan forgiveness, if you're just in an income-driven repayment plan, maybe you work for a private institution or whatever, you get student loan forgiveness automatically from the government after you've made between 20 and 25 years of payments. So this tax bill would extend that to 30 years of payments. One of the other things that they do is they eliminate subsidized loans. For a lot of people that are getting undergraduate degrees and they need student loans, they'll get subsidized loans. So these are loans that basically you take out a loan from the federal government, but the interest doesn't start to accrue until after you've graduated. That will be eliminated. And so nowadays, if this passes, the interest will start to accrue from the government from the day you take out the loans, even before you graduate. And I think this is probably the biggest change is they're putting a lifetime limit on how much you can borrow. And so now the amount that you can borrow for an undergrad degree will be capped at, I think it's around like $50,000 per year, but it's based on an average of how much your degree costs. And so if it typically costs at most universities, I don't know, $30,000 to get a degree in, I don't know, English, and if your institution charges $50,000, the government's only going to lend you the $30,000 because that's the average cost, if that makes sense. And then for people that are trying to go to medical school or a graduate school, there's a big change. So now there's a lifetime limit on how much you can borrow for a graduate degree program, and that lifetime limit is $150,000. And so if you were trying to go to medical school, you're only going to be able to borrow a maximum of $150,000 for the total cost of all of your years of medical school. And if you need more money, you're going to have to go to a private lender in order to get that. I think that's probably the biggest change because it's probably going to defer some people who maybe don't come from well-off families from maybe even entering medical school because the data kind of shows that the average cost of attending medical school ranges between $200,000 and $300,000 a year. And so now if the government is only going to allow you to borrow up to $150,000 for the cost of your education, you got to figure out how you're going to pay the rest of that. And so I think there's some real repercussions that might happen due to this now lifetime limit on how much you can borrow in student loans. And of course, they're putting this in place because they want to cap how much money people are borrowing. They feel like schools are constantly increasing tuition fees, and they feel like if they put a cap on how much the federal government's going to allow students to borrow, then institutions will stop increasing tuition each year and the costs of school will go down. Who's to say if that will really happen? But I think it's important for people to know that if you or somebody you know is thinking about going to graduate school, whether that's medical school, MBA school, or whatever, there is now, if this bill passes, going to be a limit on how much you can borrow for the cost of that education.
Yeah. If it has the impact that we're hoping for, as far as a cap on how much institutions are actually charging students for schools, and we can make it reasonable, right? If we say, okay, for a medical school or any type of graduate school, the cap of tuition for the entirety of getting that degree is $150,000, then okay, there's some parity there, right? We're ensuring that that's the most amount of debt that a person gets to take out, which can be liberating because I know many people who have much more than $150,000 of student loan debt because of their graduate school. So I think if it has that impact, then this can be life-changing for many individuals. However, my concern is that it's not going to have that impact. And only time will tell. But if the cost of graduate school programs continues to increase, then this is going to limit those who have access to those programs without getting private student loans. That means that only those who are wealthy will be able to become physicians, become dentists. And I think what is going to happen is that we're going to therefore widen a lot of the health disparities because one, we have a loss of supports with Medicaid, SNAP, reductions in Medicare, things of that nature. And then we have fewer physicians who actually come from lower economic status who can align and be maybe a little bit more empathetic towards those patient populations. So I am a bit concerned about this. Again, we're leaving many physicians with this high burden of debt and we're pushing them towards doing certain types of work maybe that are not going to be in service to the underserved. So it's a lot to take in all at one time. I like that through this income based approach, the maximum is 10% of the income. I think that that could be helpful for people to budget and just kind of understand what their student loans will look like since it has been very unpredictable recently and caused a lot of stress for people. So I appreciate that 10% is the max payment for your student loans. But then this is an additional tax that people have to consider. There are many changes that some could be beneficial, some could definitely be deleterious to the impact on our longevity and reducing burnout as physicians and also the healthcare within the United States.
So, yeah, there are some proposed changes, as you can see in this tax bill. Some of the earlier changes we talked about may be good for high income earners, some tax breaks here, tax breaks there, real estate investors, small business owners, they're like, okay, I'm with it. And then maybe some of the other downsides of this bill, the cuts that it may do to those who are on different government assistance programs or endowment programs, limits and cuts to some of the healthcare assistance programs, changes to student loans. So we have to see. We have to see. I'm trying not to get too political, but I just wanted people to be aware of what is proposed so that you can be informed. And then if you like what's proposed, maybe you might support the bill. If you don't like what's proposed, you may not support the bill. Or maybe, as is probably the case with most people, there are elements you like and elements you don't like. And so maybe you want to talk to your elected representatives and kind of advocate for the things you like and express concern about the things that you don't think are right. But hopefully, this episode was helpful for you and just getting a broad base of like, okay, what is in this bill? How might it affect me personally as I'm going forward in my financial life?
I try not to get too political either. I also acknowledge that I am extremely privileged and not everybody has the same privileges as I do. And so, how do we create an environment that is fair for all as much as we can? And so, although I appreciate a lot of the tax cuts, I'm thinking about, ooh, I'm going to leverage this bonus depreciation in my next purchase. I'm also thinking about globally what this means for us and everyone because what we do to the least of them, we do to ourselves. Just acknowledging that as well. All right, Leisha, let's move on and let's lift the mood a bit. How you spending your money, girl? How you spending your money for fun?
Well, as we are recording this, Father's Day is coming up. I think this episode will launch definitely after that time. But I am thinking about what am I going to get my dad and my brothers who are also fathers for Father's Day. People know me that I usually get people some sort of book as well as a gift, usually. And my brothers have actually started to appreciate that over the years. They talk about some of the books that I've got them that they really enjoyed. But right now, I am reading a book about setting up a trust for your family, more to like avoid probate and make sure that your heirs get what you want them to have and that sort of thing. So I'm reading this book on setting up trusts and how just having a living will is maybe not sufficient. And so I've been reading this book. I've been talking to my father about it and some of my family members, and I discovered that a large majority of them only have wills. They do not have trusts. And so I think what I might do is buy a copy of this book for them so at least they can be semi-informed about maybe why just having a will may not be the best case for them and just give them something else to consider. And so one of the ways I'm spending my fun money is maybe buying books for my family so that they can get their estate plan in place. And we'll have to do a whole episode on estate planning, but that also means that I'm trying to spend my money to buy my dad a Father's Day gift. So I haven't exactly decided what I'm going to get him just yet. I have a few ideas in mind, but usually my brothers and I will get him a joint gift. So I need to run my ideas by my brothers and see what they want to get dad. And then we will pull our money together and hopefully get him a very nice gift for Father's Day.
I love that you are so thoughtful about your gifts, girl. I need some assistance in that domain. Lord Jesus, I definitely do. Well, I am not being as generous and thoughtful as you are, I'm buying stuff for myself. No. And this is a whole backstory, but I'll spare everyone's ears. But I am thinking about continuing ClassPass. So my husband had initially enrolled in ClassPass and wasn't using it as much. I had used ClassPass back in like 2016, and I really loved it. So if you're unfamiliar with ClassPass, essentially it is a program that you can enroll in. It's a membership, and you can opt in for a certain number of points or credits. And those credits will allow you to use any of your local gyms, even restaurants now, massages, and also other types of services such as facials and things of that nature. So it allows you access to them, and you can book a service or book a class with this class pass for a certain number of credits. What I really love about this is because we have let go of our Y membership, although I'll be getting it back for the summer. And it has allowed me to try out some different types of exercises. So I do a lot of cardio as I'm preparing for this race to run with my dad, this 10-mile race. So I do a lot of running and cardio, but I wanted to add in some weights. So I booked a class to go to this gym where it was all resistance. And then I booked a hip hop dance class, and I got my nails done, and, I got a massage. And so you can do all of these things with this class pass credit, which I really love because it forces me to spend a little bit of time and money on myself, because otherwise these credits are not going to renew. So I'm like, oh crap, Brittany, it's time for you to get that massage. So I like that there's a little bit of pressure there. You get a bit more value, I think, by electing for the class pass opposed to just paying out of pocket for these things. So you get a bit more access, a bit more value. And then for me, it helps me to spend a little time and money on myself.
Ooh, I love this. I have heard of ClassPass actually. I do not have one, but my brother got one a few years ago when he was living sort of in the center of the city. And he would use it to go to like cycling classes or boxing classes or whatever. And he really did enjoy it. So I love this for you. I've definitely heard about it. Maybe you'll inspire me to get a class pass. We'll see. So I love this. I didn't know you could get massages with it. So that is definitely
Mhm.
intriguing for me, girl.
Yeah, I like that they've expanded their services. And another benefit is wherever you go, like we went on our anniversary trip to Montreal, I was able to book a class in Montreal. So I got to go to another gym in a different location. So wherever you are, I don't know if it's global, but at least in the US and Canada, you can find gyms or salons, etc., and use the credits there.
Intriguing. Intriguing. I might have to check this out. But all right, hopefully you all found this episode helpful. As mentioned, we will link in the show notes some of the previous podcasts that we were referencing. Don't hesitate to send us an email if you have a question that you want us to answer. Our email is wealthmindedmd@gmail.com. And don't forget to rate and review and share the podcast. When you do so, it just makes it easier for other folks to find us. So thanks again for all that you do, and we can't wait to come back to you next week.
Hello, and thank you for listening to our podcast. And because of that, we have something for you, our Wealthy Minds Blueprint.
Have you ever thought to yourself, I wish I could be better with money? Do you want to start investing and saving for retirement, but keep delaying because you don't know where to start? Our Wealthy Minds Blueprint is here to help.
This guide will teach you what you didn't learn in your training so you can stop being confused about money and start taking what we call wealthy minded action.
We'll help you become a master of your finances and simplify investing so you can get started today. Take control of your financial future by downloading your free copy of the Wealthy Minds Blueprint now and start building the wealth you deserve.
One of the most important things you can do is ensure you have long-term disability insurance. Long-term disability insurance secures your income if the unexpected happens and you are unable to work due to medical illness, chronic conditions, or an accident.
Unfortunately, all insurance agents aren't created equal. Some of them are so focused on making a sale that they fail to reveal certain necessary information, tell you about discounts available, or clearly explain the process. Prati Botto and his team at PKA Insurance Group are different. They have a reputation of putting people over profits and always doing what's best.
If you need life insurance or disability insurance, reach out to Pradeep and his team today. They will help you get the insurance you need with the service you deserve.
Hello, everybody. It's me, Brooke. I'm recording a little disclaimer for my mommy, Dr. Brittany Halford, and her friend, Dr. Lisa Taylor. Just so you know, they're not financial advisors, tax professionals, lawyers, or financial planners. Everything you hear is for education and entertainment. It's not strict financial advice, So use your best judgment, chat with a tax professional, and all those other people that you need to talk to. Thanks for tuning in today. Keep cruising on your journey to wealth and wellness. Bye-bye.